Hello class, this is Dr. Sharma once again. I'm going over part third of the recording of transactions. Now in this we'll be dealing with the ledger accounts and the posting of transactions to the ledger accounts. Now in the earlier video I explained to you how we'll recognize the transactions and then journalize them using the rules of debit and credit and of course the double entry system of accounting. Now in this video, I'm going to go over the posting of transactions to the ledger account. So first, what you need to do is we will be always first recognizing the transactions, and then once we analyze the transactions, we record them in a book known as a journal. It is also known as a book of prime entry. Then from the journal, we will be posting them to the ledger. So that is the posting of transactions to the ledger account. Let's begin the discussion. First is what is a ledger? Now, as I have been saying, ledger is basically a collection of different accounts. So, and as I just explained to you, ledger is the second step in recording the transaction. The first step was to record them in the journal, and then the second step is to transfer them to the ledger. Once the debit and credits have been identified and journalized, of course, the entries are made in the ledger accounts. In a manual system of accounting, a ledger will consist of a book, bound book, each account being assigned to a separate page known as a ledger folio. So that's why sometimes you will see terminology like a folio. It essentially means signifies in what page will you be able to find that particular account. So that is the ledger folio. But of course, these days, most of the businesses do a computer accounting. So in a computer environment, the ledger will simply consist of a computer file. And then, of course, that would be divided into separate segments of the file where we will be recording transactions in a different account. Whether we are operating in a computerized environment or a manual system, the double entry principle should remain the same. So it means in a journal, you will be debiting one account and crediting another account. Whatever is debited here will go to the debit side of the ledger as well. And whatever was credited in the journal, it should go to the credit side of the ledger as well. So that will always remain, and the debit and the credit should be equal. So ledger is basically defined as a book which contains a classified, that means you have to understand the word classified, because supposing if you have several customers you're dealing with, now what we want to do is we want to have the records of each customer as well as a collection of those. So that is why we will be classifying. Supposing if I have A customer, B customer, C customer, D customer, I will have a different account for all of them, and then I will be combining that and in a summary form known as the accounts receivable. So that is what we are talking of, the summary part of it. So we have, of course, we want the classified information as well as the summarized information, and it is a permanent record of all transactions. So we saw what we do in the journal. So we journalize all the transactions on a chronological order as they happen on the date. Now, once you have all those journals, supposing the manager comes to you and asks you, okay, well, what was the total sales for the last 15 days? Now, what you'll have to do is you'll have to go page by page and isolate what are the sales figures to be able to do that. But if you have a ledger for sales, it will record all sales in the ledger. So 1, 2, 3, 4, 5. So once you have all those records, then you will be able to immediately give that information. So it is also known as book of secondary entry, simply because the first is the prime entry is the journal and the second entry is the ledger. So that is why we also call it as a secondary entry. And the sequence is that as and when transactions occur, recording is made in the journal now as they occur. Now usually posting is done on of course these days the computerized accounting environment is slightly different, but in a manual accounting system people would journalize them, and maybe once a week you will be doing the posting. But of course, in a computerized environment, automatically the computer will post the transaction once the records are made in a journal, and it will go on to prepare the financial statement. So it has the life has become really really easy. But in the past, that's what we used to do: is to record in the journal and then transfer them into ledgers. So subsequently, each entry is re-recorded in the ledger. So that process of recording is known as posting. So sometimes people might ask you, what is the posting? The process of transferring the records from a journal to a ledger is known as the posting. Of course, while posting, the principles of double entry system of accounting needs to be applied in at all times. One account is debited, there has to be an equal and corresponding amount of credit in another account or account. So you could have several debits or several credits. So depending upon the situation. So that is what you mean by a ledger and the posting. So now let's move on. Posting the journal entries to accounts. This will happen. Each account where journals are posted will have number one, name of the account written on the top. So let's say we have a cash account. So on the top, you'll write the name of the account. And then ledger folio written on the top based on the chart of accounts. So as I have been saying, cash is an asset, and always the ledger folio for cash, of course, the chart of account as an assignment of number would be starting with 1, assuming it is 101. So we write that on the top. Date column is the third thing that we do. So we have a date column. Usually we have two columns for the date. Okay, so this is your date, and on top here I might write 2020, and then here I might write the month, and I will write the date here. So that will be the date column. And then we have a description or an item column. So that is the second column. So in the second column I might have a item or description. In the past we used to write the other account which was debited or credited, but these days we have stopped doing that, because in the computer environment already there is a record in the file, so we don't need that additional information. But here of course we do write, supposing if this posting is because of an adjusting entry, then we would like to write that, or if it is because of a closing entry, we will write that. So that is the description of the item column. And then next thing, we have a posting reference column. So this is your posting reference column. Okay, so we have a posting reference column. Now the posting reference column will signify from which page of the journal am I bringing this record here. So that's the reference to the journal page. So if I bring this information from page number 1 of the journal, I'm going to write page number 1, or if it is page number 40 of the journal, I'm going to write 40. Now that is your posting reference. Then what we have is we have amount columns. Now in the amount columns we have 4 amount columns. So these will be your amount, Okay, and this is your balance column. So here we'll have a amount column for debit. So let me just write in the short form DR and CR. In the balance also I'll have debit and credit. So these are your columns. Sometimes people refer to this as a four amount column ledger format. Now the ledger also can be a T-shaped ledger. So you'll have to understand that as well. It could also be a T-shape. So this is on the top, I'll write cash and 101, and all entries debited, I'll write on the left hand side, and all accounts that credit cash will be on the credit side. So that's another way of doing it. So this is the T account, as I said to you. So on the top, you're going to write the title of the account. So here in this example, I said cash account. And then on the debits, on the left hand side, I'm going to write the account is debited. And then you will be making a record on the left hand side. When the account, this is the cash account, when the cash account is credited in a journal, I'm going to write those on the right hand side. So that is how we are going to use the T account. Now, this is a typical format of a ledger account. So in this, on the top, you can see you have a cash account. So that is what we have here. We can see this is the cash account. All right. So let me take out that pen. Okay. So this one here, you can see this is the cash account. And then that's the name of the account. And on the right, you can see I've written 10. So that is the ledger folio. So name of the account is as in the chart of account needs to be written. And then we have a ledger folio based on the chart of account. Again, all assets will start with 1. Liabilities will start with 2. Owner's equity will 3, revenues with 4, and then expenses with 5. So as we have learned in the previous segment of the videos, then we have date column. So dates are recorded in the journal. As you can see, that's the third thing in the format. Next will be any additional information that needs to be provided. I gave you example of adjusting or closing entries. That's what we'll be writing there. If it is a general entry, we don't make that because a general, of course, they are the norms. So additional information will be only for adjusting entry or closing entries. We'll be talking about adjusting entries and closing entries in the next chapter. Then, as I said to you, posting reference. So this will refer to page number in the journal. Sometimes we write that page. Some people write it as J1, indicating journal page 1, or just write 1. Whatever way, it depends upon the organization, how they want to go about. Then you have two amount columns, debit and credit. These amount columns are used to indicate whether the account was debited or credited. So if cash was debited, I'm going to write in the debit column. And then I'm going to go to the balance and write the same amount. Okay. Now, the next, supposing I have a transaction whereby I have a debit of 600. So what will happen to my balance? Because this is a debit and a debit, the balance will be now 1000. So if it is same, then you add it. If it is different, then you subtract it. That's how we calculate the balance. So that is these columns, the balance columns, are used to indicate whether the account has a debit balance or a credit balance, and will be calculating a running balance as you just saw here. So that is your format of a typical account. Now I'm going to what you call show how posting is made. Let's just take the problem. Read the problem. It says On November 1st, 2020, Suman established Suman Enterprise and completed the following transactions during the month. November 1, Suman transferred cash from his personal bank account to Suman Enterprise bank account in exchange for common stock. Now, in the past, what we have been talking about is the journal. So, if you remember the rule of debit and credit, now what is the journal that I will be making? Of course, the date will be November 1st, and cash account will be debited and common stock will be credited. Now, that's the what I call journal that will do, and with the amount is going to be 80,000 and 80,000. Now, remember here I'm giving an indent. That is a practice we do. We always have a space between a debit, and we write the debit account first and write the credit account second. So that is the first transaction. Second is paid rent on Suman Enterprise office space for the month 9,600. So that would be rent expense to cash. Purchase supplies on account 4,300. Paid accounts payable 2,200, and things like that. Now these are all the transactions. Since we have already talked about journalizing aspect, I'm not going to spend much time talking about the journals, but I will be talking in detail about how to do the posting. So let's just run through the journals. Okay, so let's first read the requirement. It says journalize the entries for transaction for the month of November on page 21. So I'm going to use the journal page number 21. Now, why that is important? Because when I'm posting into the ledger, I have to use that journal page to signify it is going to that coming out of that page. And Suman Enterprise chart of account shows the following account title: cash is 10, office supplies 11, accounts payable is 20, common stock is 30, dividends 31, 40 is sales revenue, 50 is office rent expense, 51 is office salary expense, 52 is office equipment expense, and 53 is office supplies expense, and then 59 is miscellaneous expense. Number two, prepare ledger accounts using the account title as given in the chart of accounts in requirement number one. Post the journal entries into this accounts and determine the account balance after posting all journal entries. So that is your requirement. Let's move on to the journal entries. In the first journal entry, what we are going to do is we are going to analyze it. Now, the analysis part is Suman transferred cash from his personal bank account to the company's account in exchange for common stock. So, as you can see, cash and common stock. Cash is an asset, it is increasing, therefore, it will be debited. And common stock, of course, is an owner's equity, and it is also increasing. Whenever owner's equity increases, we credit it. And the posting reference you see is 10 and 30. That refers to the page number 10 of the ledger for cash account, page number 30 of the common stock. Remember that 10 and 30, we are going to write that page number only when we have posted the transaction. So that is something that you have to understand about this. These we'll be writing them only when we have posted the transaction. Okay, so that is number one. Number two is paid rent on Suman Enterprise office space for the month. Since it is for the month, it is going to be rent expense. Now here you can see office rent expense is debited and cash account is credited. As you can see, again, cash is on page 10 of the ledger and the office rent expense is 50 of the ledger. Amount is 9,600. So that's the second transaction. The third transaction was purchase supplies on account. Now, supplies is an asset, and on account basically means I have purchased that supplies on credit. Whenever you buy something on credit, If you are buying it, it is accounts payable. If you are selling it, it is going to be accounts receivable. Since in this case you are buying it, we'll be using accounts payable and the supplies account, of course. So your journal will be office supplies account debit, and the posting reference is 11, and accounts payable is of course posting reference 20, amount is 4,300. So this is the third journal. Move on to the fourth journal, paid accounts payable. Now please remember, sometimes people get confused about that. Accounts payable is now getting paid. Accounts payable is a liability account. Okay, so if it is a liability account, when we pay it, it gets reduced. So that is number one. And when the liability is decreasing, we debit it. And since we are paid with cash, the next account is cash. So accounts payable to cash is the journal. Next is earned sales revenue receiving cash. So again, you have received cash, so that's why cash is one account. Another is you're receiving revenue, so that is why we'll be using the sales revenue. Sales revenue, and cash is an asset increasing. Sales revenue is a revenue, it is increasing. When assets increase, it is a debit, and when revenue increases, it is a credit. So that's how we do the journal. Next, paid office equipment lease expenses for the month, 3,160, and miscellaneous expense. So now you have two expenses on the same day. Whenever you have two expenses, we can do a compound journal. Now, what is a compound journal? When a journal has more than one debit or more than one credit, it is known as a compound one. So in this case, you're paying two expenses and cash is involved in the payment. So you'll have office equipment expense, then miscellaneous expense, and cash. So that's what we are doing, debiting the two expenses and cash is credited. Now, one thing you have to remember is most of the 99% of the times office expenses will be debited, revenues will be credited. Now why is that? Because when we incur the expenses and we don't write back expenses very often, so that is why that is something that you can remember. Whenever you see an expense, that needs to be debited. Paid office salaries, again salaries expense, so that would be debited. So office salaries expense is debited and cash is credited with 7,000. The second last is cost of supply used was 2,000. And of course, since I have used the supplies, I'll have to credit the supplies because the balance of that account is going down and expense has to be created. So that is 2,600. And the last item was paid dividends 3,000. So your journal would be dividends account to cash account 3,000. So these are the journal entries that we have done. Now what I'm going to do is I'm going to show you how we transfer those journal entries into the ledger. So that would be the posting part that as we have been talking about. So as you can see, I have a journal, cash account is debited and common stock is credited. So this is the journal that I have done. So now what I have to do is, if I illustrate using a T account, cash is one account and common stock is another. Now, in the beginning, you can always start doing this and then you can go on to using the actual format. So you can see cash here is debit. So I'm going to go on to the left hand side, 80,000 on the debit, and common stock is credit. So I'm going to write on the right hand side. That's the credit side, 80,000. So that is the posting you do if you were using a T account. But if you are using the 4-column ledger account, that's what you can see. What we have done is date 2020, November 1st. In item, we have nothing to write so far because this is a general transaction. posting reference is 20. Now why it is 20 is, of course, you can see I brought that information from page 21 of the journal. So that is why you can see cash account, um, and the page number is 10 in the ledger. So that's the posting reference. And you can see the date is November 1st. And the posting reference is 21 in the journal, and the amount is 80,000 debit. And of course, since this is an asset account, it will also have a debit balance. That's how we do the first one. The second is common stock is credit. So that is why you can see that is in the written in the credit column, not in the debit column. And of course, we'll have a credit balance as well. So that is how we do the posting. So here in the T account, that's how we do, and in a proper four column ledger, that's how we do that as it is being displayed there. Now the next journal we had was office rent expense to cash. Now remember, I already have a cash account opened. So in a T shape, what will happen is now office rent expenses, another account. So let me open that in a T shape, office rent expense account. Now the journal, as you can see, is office rent expenses debit, and the amount of the debit is 9,600. So I'm writing here on the debit side. Cash is credit. So I already have a cash account. So this is going to be 9,600 on the credit side. So now what will happen is our balance in cash has gone down from 80,000 to 70,400 because I have used the cash 9,600. So that's what you see there posted in the cash account and the debit side of the rent expense account. So that's how we do the posting for the second transaction. The third one, of course, is you have a journal which says office supplies is debit and accounts payable is credit 4,300 and 4,300. So I'm going to open a T shape, let's say office supplies, and it is a debit of 4,300. So I'm going to write 4,300 on the debit side. And accounts payable is credited. So another T account, I'm going to open accounts payable, and on the credit side is 4,000. So we are following the double entry system of bookkeeping and accounting. So that is, I have a debit of 4,300 and a credit of 4,300. So that is what is happening in the ledger postings as well. Next journal is accounts payable is debit and cash is credit. I already had a cash account. Remember, I had a cash account where 80,000, this was cash account, 80,000 was a debit, 9,600 was a credit. Now again, I'm going to credit 4,300. So my balance will further go down to 68,200 because of this transaction. Now accounts payable, of course, there was a transaction of 4,300. Now what we are doing in this transaction is we are paying that 2,000. So therefore now the balance will go down from 4,300 to 2,300 because I have paid 2,000. So remaining to be paid is 2,000. Okay, so that is, so this was 2,200. So the new balance will be 2,100. Okay, so that is how we do the posting for different ledgers. Now another journal that we have done is cash account debit and sales revenue credit. So you can see I've gone to the cash account and I've written the 37,500 in the debit column. Now, because asset account will increase with the debit, my new balance will go up to 105,700. Sales revenue is the first time that I'm having a transaction, so I have 37,000 in the credit, and I will also have a credit balance. So that's how we do the posting of those transactions. Next, I had a compound journal entry where I had two expenses debited now and then a credit of cash. Remember, cash is credited only once. So I am writing that credit amount of 4,760 on the credit column of the cash, and then my balance, of course, will go down by that amount, and I get a new balance of 100,940. So now office equipment expense and miscellaneous expense are debited respectively with 3,160 and 1,600, and they continue to have a debit balance. Next journal is office salary expense is debit. So I have opened the office salary expense, and cash is credit. So you can see I have credited that cash with 7,000. So that is how we continue to do the posting. Office supply expense is debit and office supplies is credit. So because of this, my office supplies balance goes down, but my office supply expense goes up. Now the next one is I have a dividend payment of 3,000, and therefore my balance, final balance is 90,940, and dividends is 3,000. So these are the complete journal entries that we have done so far, and these are the complete ledgers. So what we can do is we can look at the amount figures there for each of the ledger accounts and see what were the balances that you have calculated. So if you look at the balances, the final balance for cash is 90,940, office supplies is 1,700, and accounts payable is a liability. It has a credit balance of 2,100. Common stock owner's equity is a credit balance of 80,000. Dividend is 3,000 debit, and then you have 37,500 of sales revenue, 9,600 of office rent expense, and office salary expense of 7,000. So if someone were to ask you, like, what is the total amount of sales revenue? Now, what you have to do is if you have only the journals, then I have to go through and look at it. Okay, where is the sales revenue? This is one. Anything else? No. So now then I can say, okay, the sales revenue is 37,500. But if I have a ledger, separate account for your sales revenue, then what can happen is I can just look at that and see that 37,500. Similarly, supposing, let's say, I want a balance of cash on the 16th. So I have a cash here, I have a cash here, I have a cash here, and I have a cash here. So now in some it is a debit, in others it is a credit. Whenever it is debit, I have to add them up, and whenever it's a credit, I have to subtract. But if I have an account, then what I can do is on at the end of the 15th of the month, I have 105,700 as the balance in my cash account. So this is the information, summarized information you can get from the ledger's account. So with that, we come to an end to the presentation. Hope you'll find this useful. Thank you very much for listening to this. Now, what we are going to do is we are going to go on to the next presentation. I'll be seeing you then. I will be talking about the trial balance. Thank you.